REITs have been one of the most frustrating areas of the market for many income investors. For years, investors heard the same story. REITs are cheap. REITs pay dividends. REITs should benefit when rates eventually fall. But every time the comeback looked close, something got in the way. Higher rates, weak sentiment, debt concerns, office headlines, and competition from Treasuries and money market funds. So now the question in 2026 is simple. Are REITs finally at the bottom? Or is this just another false comeback? That is the key question for this video. Because a cheap REIT is not automatically a bottom. A high dividend yield is not automatically an opportunity. And a price that has already fallen is not automatically safe. A real bottom needs improving fundamentals. So today, we are going to look at interest rates, FFO, NOI, occupancy, balance sheets, dividend safety, sector winners, sector risks, and what investors should actually watch before calling this a REIT comeback. A cheap REIT is not automatically a bottom. A bottom needs improving fundamentals. To understand the comeback story, we first need to understand why REITs struggled so much. The biggest problem was higher interest rates. REITs are real estate businesses, and real estate is very sensitive to the cost of capital. When rates rise, debt becomes more expensive. Cap rates can move higher. Property values can come under pressure, and investors demand higher returns from income assets. That means REIT valuations can compress even if the underlying properties are still operating reasonably well. On top of that, REIT dividends had to compete with Treasuries, money market funds, and other lower-risk income options. If an investor can earn attractive income with less volatility, REITs have to work harder to look appealing. Then add recession fears, tighter credit, refinancing risk, and weak property sectors like office. That is why REITs were not just punished by bad headlines, they were punished by higher discount rates. And that is why the 2026 comeback story starts with one major question: what changed with rates? In 2026, the story started to look different because rate pressure stopped feeling as extreme as it did during the worst part of the cycle. The Federal Reserve maintained the federal funds target range at 3.50% to 3.75% in June 2026. That does not mean rates are low, they are not, and it does not mean the REIT problem is automatically solved. But for a sector that was punished heavily by rising rates, stability matters. The comeback story begins when rates stop getting worse. If investors start to believe that the most aggressive rate pressure is behind us, REIT valuations can start to look more interesting again. Income investors may begin looking back at real estate dividends, and long-term investors may start asking whether the bad news is already priced in. But this is where we need to be careful. A rate pause or a rate cut expectation can create a rally, but a real recovery still needs cash flow. The comeback story starts when rates stop getting worse, but it only survives if cash flow holds up. So now we need to look at the first real signal, FFO and NOI. The first signal is FFO and NOI. For REITs, these are critical. FFO, or funds from operations, is one of the most important cash flow metrics investors use to analyze REITs. NOI, or net operating income, shows how the properties themselves are performing before corporate-level costs and financing details. If REIT prices are rising, but FFO and NOI are weakening, the comeback may be fragile. But if FFO and NOI are improving, the recovery has something real behind it. According to the REIT industry tracker, 65% of REITs reported year-over-year increases in FFO. FFO increased 14.8% from 1 year ago. NOI increased 5.6% year over year, and same-store NOI increased 3.8% year over year. That matters, because this tells us the REIT story is not only about interest rate hopes. There are signs of operating strength too. If FFO and NOI are improving, the comeback has something real behind it. But cash flow is only one part of the picture. The next question is whether the buildings are still occupied and tenants are still paying. The second signal is occupancy and demand. A REIT can look cheap on paper, but if the buildings are empty, the story changes quickly. Occupancy tells us whether the real estate is still useful to tenants. It also gives us a clue about pricing power, rent collection, and long-term demand. NARI reported that occupancy for all equity REITs was 93.2%. That is an important sign. It suggests that across a broader listed REIT universe, many properties are still being used and tenants are still in place. But we cannot treat all REITs the same. Data centers may have strong demands from AI, cloud, and digital infrastructure. Industrial REITs may benefit from logistics, supply chains, and e-commerce. But office still requires much more caution because hybrid work, vacancy, refinancing, and obsolete assets can create pressure. So occupancy helps the comeback story, but sector quality still matters. A REIT's bottom is stronger when buildings are still occupied and tenants are still paying. Now we need to ask another question. Can these companies handle their debt? The third signal is balance sheets and debt. This may be the most important difference between strong REITs and weak REITs in a higher rate environment. REITs are capital-intensive businesses. They buy properties, develop properties, finance acquisitions, refinance debt, and sometimes issue equity. So when rates are higher, the balance sheet matters more. NAREIT reported debt-to-market assets of 35.4%, and the weighted average term to maturity of REIT debt was 5.9 years. Those numbers suggest that at the industry level, leverage remained controlled and debt maturity was not extremely short. But investors should still look carefully at each REIT. When does the debt mature? What is the average interest rate? Does the company have access to capital? Does it have a strong credit rating? Can it refinance without destroying shareholder value? The REITs that survive high rates are usually the ones that do not need desperate financing. And once we understand debt, the next step is valuation and dividend yield. Because cheap can be opportunity, but it can also be a warning. The fourth signal is valuation and dividend yield. After a long period of pressure, many REITs can start to look cheap. But cheap compared to what? That is the key question. A REIT should be compared with FFO, AFFO, net asset value, dividend safety, growth prospects, and cost of capital. A low price alone is not enough. A high dividend yield alone is not enough. Sometimes a high yield is a real opportunity. Other times, it is the market warning you that the dividend may not be sustainable. That is why investors need to look at payout ratios, debt, leasing trends, and whether cash flow supports the dividend. If the dividend is covered and the balance sheet is strong, a higher yield may be attractive. If the dividend is stretched and refinancing risk is rising, a high yield may be a trap. The question is not whether the yield is high. The question is whether the yield is supported. And once we understand valuation, we can look at which sectors may actually lead a REIT recovery. The REIT recovery will probably not be evenly distributed. Some sectors may lead, others may lag. Data center REITs may benefit from demand connected to AI, cloud infrastructure, and digital capacity. Industrial REITs may benefit from logistics, supply chains, and e-commerce. Net lease REITs may attract investors because of long contracts and more predictable income. Self-storage may still be adjusting after the post-pandemic boom, but the business model remains resilient. Healthcare REITs may benefit from demographic demand, although operator risk still matters. The key point is that REITs are not one single thing. A data center REIT, a mall REIT, a net lease REIT, a healthcare REIT, and an office REIT can all behave very differently. So when investors say REITs are coming back, the better question is, which REITs? The REIT recovery will probably not be evenly distributed. And that means we also need to talk about the sectors and balance sheets that still deserve caution. Some REITs may recover, others may stay cheap for a reason. Office is still the obvious area where investors need to be careful. Hybrid work has changed demand. Vacancy can remain high in weaker markets. Refinancing can become painful, and older buildings may need major investment just to stay competitive. But office is not the only risk. Highly leveraged REITs can struggle if refinancing costs rise. REITs with weak payout ratios may face dividend risk. REITs that with weak tenants may look fine until rent collection becomes a problem. And REITs that depend too much on external capital can struggle when the market does not reward them with cheap funding. This is why a REIT comeback should not mean buying everything with a real estate label. Some REITs may recover, others may stay cheap for a reason. And this brings us to one of the biggest risks in 2026, the false comeback. The biggest risk is a false comeback. REITs can rally simply because investors expect lower interest rates. And when rate expectations improve, the whole sector can rise together. That can feel like confirmation, but it may not be. A rate rally can lift strong REITs and weak REITs at the same time. Lower rates do not automatically fix bad debt. They do not automatically fix weak assets. They do not automatically fix bad tenants. They do not automatically fix unsustainable dividends. And they do not automatically fix a poor balance sheet. So if a REIT rises only because rates look better, but the business is still getting worse, investors need to be careful. That may be a trade, but it may not be a long-term investment. A rate rally can lift bad REITs too. That does not make them good investments. And if this kind of no-hype REIT analysis is useful, this is a good place for a quick pause. This is the kind of REIT analysis we focus on at Boring Money Wins, not just asking whether prices are down, not just chasing the highest dividend yield, not just assuming every rate rally is a real recovery. The goal is to separate comeback from speculation, to look at FFO, NOI, occupancy, debt, dividend safety, valuation, and sector quality. If you like no-hype REIT analysis that focuses on what actually supports the investment thesis, hit the like button and subscribe to the channel. It helps the channel grow, and it tells YouTube to show more practical investing content to people who want real estate investing without the noise. Now let's turn this into a practical checklist. How can an investor judge whether a rate may actually be bottoming? Here is a practical checklist for a REIT bottom. First, has FFO or AFFO stabilized? Second, is NOI still growing? Third, is occupancy healthy? Fourth, is debt manageable? Fifth, are debt maturities spread out? Sixth, is the dividend sustainable? Seventh, is the valuation truly discounted, or does it only look cheap because the business is weakening? And eighth, does the sector have real demand? This checklist matters because charts can be misleading. A stock price can look low and still go lower. A yield can look attractive and still be unsafe. A REIT can look cheap and still have weak fundamentals. So the investor should not call a bottom just because the chart looks low. Call it when the business stops getting worse. That is the difference between buying weakness and buying a recovery. Do not call a bottom because the chart looks low. Call it when the business stops getting worse. Now let's talk about how to invest in a comeback without betting everything at once. The good news is that you do not need to perfectly call the bottom to benefit from a real recovery. Trying to buy the exact bottom sounds great, but in real life it is extremely difficult. A more practical approach is managing risk. One option is using a REIT ETF for diversification. Another option is building a basket of stronger REITs across different sectors. Investors can avoid putting everything into one property type. They can buy in stages instead of all at once. They can reinvest dividends with discipline, and they can keep a margin of safety instead of assuming everything will go perfectly. This approach may feel less exciting, but it is usually more realistic. Recovery investing requires patience. It also requires humility because nobody knows the exact bottom in advance. You do not need to perfectly call the bottom to benefit from a real recovery. But this REIT comeback thesis still is not for everyone. So let's separate who may like it and who should be careful. The REIT comeback thesis may appeal to patient income investors. It may appeal to investors who want liquid real estate exposure. It may appeal to investors who understand that REITs can be volatile. And it may appeal to people who can tolerate interest rate cycles. But some investors should be careful. If you need short-term safety, REITs may be too volatile. If you cannot tolerate drawdowns, the sector can be emotionally difficult. If you buy only because the dividend yield looks high, you may end up in yield traps. And if you think all REITs are the same, you may ignore the biggest risks. Sector matters. Debt matters. Dividend safety matters. Valuation matters. REITs can reward patience, but they can punish investors who confuse yield with safety. So the comeback story may be real, but it needs to be handled carefully. Now let's bring everything together into the final verdict. So, are REITs finally at the bottom in 2026? The honest answer is that the setup looks better than it did before. Rate pressure is less extreme. FFO and NOI are showing positive signs. Occupancy remains healthy at the broader equity REIT level, and balance sheets at the industry level still show manageable leverage and meaningful debt maturity. Those are real positives. But that does not mean every REIT has bottomed. It does not mean every high yield is safe. It does not mean office is fixed. And it does not mean weak balance sheets suddenly become strong because the market feels better. Maybe the bottom is forming, but it is not the same bottom for every REIT. The REIT comeback is not about buying everything. It is about finding the REITs whose fundamentals survived the storm. And boring money usually wins, because boring money usually survives.